Hi, everyone. This is Tim Melvin of the Tim Melvin Deep Value Report and the Banking on Profits newsletter, coming to you from down here on a very hot, muggy day in Central Florida. I hear the booms outside telling me that our latest thunderstorm is getting ready to arrive as I'm recording this. And of course, all the chatter this afternoon is the Chinese devaluing the yuan, and the market's actually fallen. There's some guys being indicted for making a bunch of money, stealing files, breaking cybersecurity to commit insider trading. I think this might be the first case of that. It's going to be interesting to see how it develops. We will see more of that type of activity. Real flavor of doom and gloom on the TV that I've got on behind me here this afternoon. Let's just take a deep breath. Yeah, we were down today, but guys, we're like 2% off all-time highs. And somebody said to me earlier, yeah, but the real damage, it's in those small caps. It's in the Russell. Yeah, the Russell 2000 is taking a beating. It's 6.48% off the annual highs. Now, there is some sectors of the market that have done a lot worse. But look, we're not into a free fall, and there's not a whole lot of profit and inventory creation event kind of going on here. So let's just all take a deep breath, stay calm. It's not a time to flood your cash into the market. We had a little bump. Now, hopefully, and I'm very hopeful, I'd like to get a whole bunch of little bumps and get us a real nice correction going. It's been over 1,400 days since we had a 10% correction in the stock market, and that's a little frustrating for a value guy like myself. So I'd love to see this market get down. The heck with 10%. Let's go down 20. Let's have some fun and create some real buying opportunities and get some safe and cheap inventory created. That would be fun for me. But if you look at it, stocks are actually up for the week about 43 basis points. The all-world URTH index is up 0.16 basis points, and the leader at 86 basis points for the week is, of course, the Community Bank Index, that QABA, that has been a pretty much continual leader in 2015. Is the small banks just ignore everything that's going on and are reacting to the fundamentals of the industry, which right now are quite good. There's increased M&A activity as smaller banks are, have to look for ways to get up over the $1 billion mark, and that path is usually merger or acquisition. So, but we've also got strong earnings, solid loan demand, dividend increases, stock buybacks everywhere you look. And again, if you're not invested in the sector, you're either allergic to money or addicted to trading. In either case, call a doctor. You need to be in the small bank stocks in 2015 and going forward. So anyway, of course, oil prices, right back down, hit another low today, closed down once again today. And there's a lot of wild speculation on Wall Street as to where energy is going to bottom, how low can it go. There's only one real answer, and anybody that says anything but is either a fool or a charlatan, and the answer is I don't know. OPEC is saying they're never going higher. T. Boone Pickens is saying they're going to go higher by the end of the year to at least 70 and higher than that in 2016. We all hope he's right because we do own energy stocks. And the private equity guys are saying they're going to go higher someday. And they've got that 5 to 7 year time frame. They're probably going to be the closest to being right in this whole thing. But look, you've got so many economic, demographic, social, and geopolitical factors pushing oil prices around right now that anybody that comes to you and says that they've got some sophisticated pricing model that's going to time the bottom in oil they're insane. We don't know where oil prices are going to go. We'll have to see how it all plays out. Now, we own oil stocks in the portfolio. We kicked all the riskier ones out in January. And we like what we have left. We think that we're going to make a lot of money off them over the next 5, 7, or even 10 years. If we have to wait that long, we think we'll sell them for many, many times what we originally paid for them. But in the meantime, it is kind of a frustrating thing to sit here with these stocks right now. But I've done it before. I'm sure I'm going to do it again. So we like the oil stocks that we do have. When we look at the sector, not really excited about rushing in to buy more because I have to tell you, what I'm seeing is EBIT, earnings before interest and taxes, are falling faster than the stock prices, so those margins are getting blown up. A few weeks ago, Chevron had an enterprise value to EBIT ratio of 7. It's 10 today after that last earnings report, and Exxon is now up in double digits as well. Now, that's not particularly overpriced, but it's not interesting enough for us to add to the position at this level either. We like Chevron going forward. We're going to wait for the price to come down just a little bit more and get that ratio back down to around 50% of the median stock in the S&P 500. The median stock EV to EBIT ratio in the S&P 500 is about a little over 15, so we want to buy around 7.5 or so. So we'll see if that happens. It gives us a good entry point into the Chevrons and Exxons of the world. So you've also, credit conditions are falling apart fast Okay, the list of stocks that actually, just using Z scores and F scores, the number of stocks that have good solid scores is shrinking just about every day as these earnings reports come out. There's a lot of borrowed money out there. Cash flow is not covering costs. It's kind of an ugly picture. So there's very little that's safe and cheap in the oil sector. We own some of those names. If more are created, we'll certainly buy them. But right now, we're not getting the right pricing along with the right margin of safety to be rushing deeper into the oil patch. Will it happen at some point? And again, when? Only one answer, guys. I don't know. All right. When it comes to oil, nobody knows right now. We just have to sit here and let this play out over however long it takes. I'm kind of with the private equity guys. At some point in the future, oil prices are going to go higher. There's going to be an enormous amount of money made by patient investors who can deal with the short-term volatility. But I can't tell you the time frame, and I don't think anybody else can either. I've been doing a lot of reading of studies lately. Was down at Flagler Beach, and the time I did not spend running, trying to force the dog to go into the ocean. Good sport. She went once. Said, okay, that was fun. We're not doing that anymore. And so for the rest of the time we were there, the few days, she just kind of hung out under the umbrella while I read a book. So, and a bunch of studies. I took some studies down there with me, and I read some really interesting ones. A lot of my friends and associates say, these academic guys, I don't pay any attention to them. We're down here in the pits, elbow to elbow, and, getting it done every day. They don't know what they're talking about up there in the ivory tower. Yeah, some of them do. There's a lot of studies that are, of course, just published to Paris type stuff, or, somebody's dissertation they had to publish to graduate. But there's a lot of good stuff turned out by academia. Just look at, stuff like the work that Tobias Carlyle and Wesley Gray have done on enterprise values as a measure for calculating stocks. And then Aswath Damodaran, whose name I always mispronounced and probably just did again, also just did a study that was really interesting because he showed that for non-financial stocks, enterprise value is probably the best measure of value, although price to book is certainly still valid. But for financial stocks, insurance companies, asset managers, banks, big and small, price to book value is still the most important metric. So that was kind of a cool study that I read while I was down there last week. Flipped through that one a little bit. The most fun study was done by a guy from Stanford and a guy from University of Chicago, both great, fantastic business schools. Got the name of it. If you want it, you can email it to me. But the name of the study is Leverage Small Cap Value. But if you want if you want a link to it, just hit me up by email, and I'll be happy to send you a link back. These guys went through, and they looked back all the way back to the 70s, with a very long time frame, and they looked at small cap stocks that had a lot of debt, and they were looking to replicate private equity strategies. So they added, a few criteria. You want to have very low enterprise value to EBIT ratio in the bottom 25% of the market, which would put it at 8 or less using today's market. They found that they didn't just replicate private equity; they blew private equity off the shelf. The particulars of the company was they had high debt to equity ratios, but the debt to asset ratios were not quite as high. They had a very low enterprise value to EBIT. And when you bought the top 25, as ranked by their study, you just crushed the market. I think the returns were in the mid-20s, let's put it that way, with, I believe, a 1-year holding period. Very interesting study, worth your time. All sorts of implications for individual investors. Now, me being me, I can't just go buy those highly leveraged stocks. I came back and I reworked it, and all I did was add the Altman Z-score. Okay, it had to be 3 or higher, indicating that this company, while heavily indebted, highly levered, there was no possibility or danger of a significant financial distress event over the next 2 to 3 years. In other words, they were going to keep the doors open, the lights on. Nobody was filing bankruptcy here. When I added that to this portfolio of cheaply priced on an enterprise value to EBIT basis, highly levered stocks, it just kills the overall stock market over time. With one enormous caveat here, okay? This screen crushes the market by like a 3-to-1 margin in rising markets. Just kills it. If the stock market's going up, this thing is like having your own personal ATM loaded with $1,000 bills. When the market's going down, you're feeding all those $1,000 bills because it just gets crushed and does much worse than the market. So there's valuable information in there. We got to figure out the right way to work with it. I've got some ideas, and we'll be trying to work it in, get it into the deep value portfolio a little bit if we can do so on an appropriate basis. Fascinating study that individual investors can not only recreate private equity type returns, they can exceed them by buying small cap stocks that have high amounts of leverage and are also cheap on an enterprise value to EBITDA basis. And then, of course, I just simply added in that one huge safety factor in Altman Z-Score. Stock portfolio still does well, but you really get you get it kicked in a bad market, and kicked rather severely. So now I read another interesting study, and I read this one over the weekend as well, and lots of work to do with this one because I think the initial conclusions of the study are interesting but not complete. But the study took the market and it just looked at times when the market was undervalued using the Shiller PE ratio and when it was overvalued using the median Shiller PE ratio of like 16.5, I think, for the U.S. market. Now, when the market was undervalued, they bought traditional Graham-like value stocks based on price to book value, price to net current asset value, and things of that nature. And then when the market went over the median Shiller PE ratio, the strategy switched up and started buying quality stocks using measures like Novi Marx's definition of quality. They looked for value quality stocks. Now it's kind of an interesting study because you're using asset and liquidation value when stocks are deeply undervalued, and you're using quality and value when they're overvalued. And if you think back to times like 2003 to 2005, and I'm going to say like 2008 through 2010, Value Line was reporting that the junkie section, the 5-rank stocks, were just blowing away everything, turning in high double and triple digit returns, while the 1-rank stocks didn't do so well, and that later reversed and flipped as the bull market aged. It's got some interesting implications that we might be able to put into our stock picking process. And I also want to use GDP to market cap as my measure of over and undervaluation and see if that works as well as the Shiller did in the study. I think the Shiller is a little incomplete, a little more difficult to use. It should be kind of interesting. Might turn out to be nothing, but doing the work is fun and keeps me out of trouble. So that's just part of my philosophy. I'm a big reader. I believe always be learning. I've been doing this for 30 years. I try to learn something new every day. I don't always, but I certainly try to. But I'm trying to constantly learn new things. Markets are changing. Measures of financial valuation tools, they're always changing. When I first started doing this, there were no Piotrowski F scores. Robert Novi Marx was, had not done any of the work that he's done. None of the tools that we work with on a regular basis today even existed. There was no such thing as a small bank stock activist back in those days. So markets change. I try to change with them as much as I need to. I'm still, a curmudgeonly value guy. Price to book, price to liquidation value work very well. But you know what? We've discovered that price, enterprise value to earnings before interest and taxes works as well. So that's gone into the quiver of tools that we use because I'm not allergic to money. I like making it, and if these tools can make me money, then I'm going to update my thinking a little bit and add them to the arsenal of tools we use to select safe and cheap stocks. We touched on small bank earnings. We're getting deeper into earnings season. 48% of the companies in the S&P 500, folks, that have reported so far are showing revenue declines. It's not just oil. Okay, that's going to get to be problematic. The earnings growth that's been out there for years has been coming from financial engineering, particularly stock buybacks and cost cutting. You cannot cut costs along the path to strong, solid, continued profits. At some point, this all has to end. Don't know when. But now Jesse Felder, who runs a great blog, it's called the Jesse Felder Tumblr, I believe it is, but smart guy. He started with Bear Stearns years ago. He's an independent trader. His blog's worthwhile reading. I usually update, on his site about once a week. But he pointed out something very interesting. Oil prices could get to be an enormous problem because sovereign wealth funds have $6.8 trillion of stocks and bonds under management. Now, these are the sovereign wealth funds set up, of course, by governments. 60% of the money in those funds is surplus revenues from the oil and gas businesses in these countries. Okay, so all this money is flowing in the form of oil and gas profits. Well, there's no oil and gas profits because nobody's making money pumping oil and gas right now. It's all about protecting market share. It's being done at a loss in many areas of the world. So what happens now when this money starts coming back out? Because here's the government's choice: cut costs, deny benefits to the populace, and in some parts of the world, that means that you're risking having your government overthrown. Okay, so not a lot of that's going to happen. So you're going to see money coming back out of these sovereign wealth funds to meet government spending needs. Now, that's an issue because the money is invested in stocks and bonds in order to bring it out and use it to, help your citizens and keep your country afloat. You got to sell some stocks and bonds, and that could put global pressure, selling pressure on the global markets. The major concern right now is that things are getting a little close to the line in Norway, which has an $875 billion sovereign wealth fund. It's one of the biggest ones in the world. They own 1% of all stocks in the world, 2% of all European stocks. So that's not an insignificant amount of assets that could start to see some selling pressure if they need to start pulling money out of the sovereign wealth fund to meet current government expenses. This is something that could significantly alter the condition of markets in the world and added something new for you to worry about late at night if you're the type of person to sit up and worry about these things. Fortunately, I am not. There's nothing I can do about them. Outside of the small bank portfolio, we have enormous amounts of cash. We're 40% or higher in both the international and the regular deep value portfolio, and I think we're creeping up on 20% even in the income portfolio right now. So we're not too concerned. We would actually love to see a sustained wave of selling that got us down 20% from the all-time highs. That would create a significant amount of safe and cheap inventory. We could get our cash to work, and we'd be real happy about that. If it doesn't happen, our small banks are going to keep going higher and higher in a rising market, so we're going to make a ton of money there. The takeover wave is still very much intact across that sector. That's just going to benefit us. So markets go up, we'll be fine. If they go down, we'll be deliriously happy and have a great opportunity to get all of our money to work. So if you're kind of combining between deep value and the small banks, you're doing just fine right now. It's an excellent environment for us, and we've got lots of dry powder to take advantage of any future opportunities created by a market setback. So anyway, about midway through August here. It's very hot down here, and I have to tell you, absolutely love it down here in the summertime. I don't know what you people are talking about. You can be too cold, but I don't think you can really be too warm. I'm getting to that point in my life, I think. Baseball is heating up. There's some very exciting pennant races in 5 of the 6 divisions. The Kansas City Royals are walking away with the AL Central. They've got a 12-game lead. Really surprised by that because I thought Detroit would put up a better fight, and I certainly thought Chicago White Sox were going to be a lot better this year. But I was wrong. But there are a lot of divisions. My Orioles are just still right in it. Of course, with my daughter living in Chicago now, we're all kind of adopted Cub fans just a little bit. And so the Cubs are, look like they might be in position to make a run for it. They're one of the hottest teams in baseball right now. So very exciting time to be a baseball fan. Of course, football is gearing up. Both my 2 college teams, lifelong college teams, Navy being from Annapolis and Notre Dame being an Irish Catholic kid growing up in the late 60s and early 1970s when that was, it was almost as important as Sunday Mass was Saturday afternoon Notre Dame football when I was growing up. So the NFL looks like parity everywhere you can look. I don't see a real clear, this is absolutely the best team in football in the NFL. So if you're an NFL fan, it should be an exciting time. Now, trying to adopt the Florida Gators as a third college team. First couple years down here, they've made it pretty difficult because they were very boring. It's supposed to be a lot better this year, so we'll see how that plays out. We're in the slow part of the book calendar. Not much being released, although Jack DeBrule had another book out in his series. Highly recommend his writings. They're fascinating stories, great adventure stories, so you might want to check that out. That came out on Tuesday. Other than that, looks a little slow, but that fall book publishing schedule just couple weeks away there on the other side of Labor Day, and there'll be some exciting stuff coming out to keep us all happy with our recreational reading. Anyway, the most important season is this week. To heck with the NFL, and this is even a little bit more important than baseball for a short period of time, and that's the 13F season. They're starting to come in. Two of our favorite activist bank stock investors have already filed, and we've been through the filings, wrote about those on Real Money. One will be up tomorrow as soon as we finish that up, and one was on Monday, so you'll have those to go over if you're a Real Money subscriber. Or I believe you can actually look at 8 Real Money articles a month for free now if you just put in your email address. So you can check those out. Of course, subscribers, we'll be talking about them later in the week when we do the weekly updates and talking about who bought what. And Banking on Profit monthly subscribers will also get the complete 13F updates fairly early next week. The deadline, I believe, is Friday. But we're going to be looking to see what people like Marty Whitman and Michael Price and Firefly Value and Cy Jacobs and Paul Isaac and some of the other really successful value and activist investors have been doing with their clients' money in the second quarter. This is like having the world's best research department working for you for free. When these money managers and hedge funds file their 13Fs, it's just simply a matter of taking this quarter's, comparing it to the last quarter's, and you know what they've been buying or selling during the second quarter of the year. And since the market hasn't really done much since June, the end of June, realistically, most of these stocks you're going to be able to buy at the same or better prices than these, really successful activists and value investors have done. So, very exciting week around here. My wife gets a little tired of it because we do start to pile paper up as I print all these things out. But hopefully, we'll come up with some great ideas we can add to the portfolios or put on to our watch list for future purchase when the markets do in fact come back in our direction. Anyway, that's all I've got for you here today. The thunderstorm should be hitting. I can tell by the smell coming up the stairs that dinner's almost ready. So I'm going to leave you here and hope that you guys have a great week, and we'll talk to you next week.